The U.S. industrial market took another step forward during the third quarter of 2013, with market fundamentals displaying solid quarter-over-quarter improvement. The overall national availability rate decreased for the 12th straight quarter, dropping 30 basis points during that July to September period to 11.7%. 55 million feet of industrial space was absorbed nationwide during the third quarter, up from 48.5 million feet in the second quarter. 20.3 million feet of new supply came online during the third quarter compared to 15.3 million feet in the prior quarter, and the national average net rental rate edged up to $5.73 per square foot, with the landlord concessions tightening in key gateway markets. The Midwest was the most active region during the quarter, as strong demand for the auto production and logistics sectors, especially in Detroit, Indianapolis, and Cincinnati, helped drive a 50 basis point quarterly drop in the region's availability rate to 9%, the lowest regional rate in the U.S. In the West, strong demand for large, modern facilities resulted in a spike in development activity in Southern California, where, as of the end of the quarter, 16.3 million feet of industrial product was under construction. 12.3 million feet of that was in the Inland Empire alone. And on the East Coast, leasing activity in northern New Jersey and Miami, while still strong, was down from levels from a year ago. However, both of these markets will likely benefit from expansion of the Panama Canal. Improving market fundamentals, coupled with historically low interest rates, drove up demand for industrial properties among investors, with investors outnumbering listed properties in the market 4-1. Year-to-date sales activity for industrial properties reached $31.9 billion. That's up 33% compared to the same 9-month period in 2012. Meanwhile, the average national cap rate did inch up slightly to 7.7%. In search of higher yields, investors did turn towards secondary markets like Philadelphia, Jacksonville, Sacramento, Phoenix, and Detroit. Amid strong demand from logistics and consumer goods users for Class A industrial product, Chicago absorbed almost 3.6 million square feet of space in the third quarter of 2013, the market's 13th consecutive quarter of positive net absorption. As a result, Chicago's availability rate dropped 20 basis points during the quarter to 8.5%, with the highly sought-after Class A space representing just 16.2% of the total available space in the market. With Class A space options limited and demand strengthening, construction activity is quickly increasing. Of the 5.5 million square feet of construction across Chicago, almost half broke ground during the third quarter alone. Over the next couple of years, retailers and food companies will comprise the majority of major moves or expansions, with Peapod, Trader Joe's, Home Depot, and many others either having pulled the trigger or actively discussing lease or build-to-suit options.